Hi, I'm Randy McLean from Waypoint Analytics. This is Jonathan Bine from Real Results Marketing. Jonathan and I have been having a great discussion this morning about segmentation and other things, and so we're going to carry on that discussion and let you in on some of the things we're thinking about the other segments. So the next group that I wanted to look at was something that you and I have had some debate over the years, and it's been a little bit of disagreement on the small accounts. And everybody's probably heard of the small order problem before, and a lot of people are working with it. Everybody has a counter sales operation or a cash sales customer at the very bottom of their profitability ranking, and a lot of that is due to these small accounts that order infrequently small quantities. And so when we look at the regular accounts, or what we call the regular accounts, we've bifurcated those into the money-making below average cash flow accounts and the money-losing below average cash flow accounts, and that has been a great epiphany. I'd always considered it being a big challenge and a near impossibility to generate any kind of significant profitability with the small accounts. What's your opinion about that?
Well, the trick on those is that you can't use field sales as the way to either acquire or grow those accounts. So your brilliance and your focus is on the whole cost to serve world, but the cost to acquire, if we were to look at customer lifetime value, the potential, all of that has to be aligned. So it's really an issue of channel alignment in terms of how we acquire and how we serve those customers.
Well, that makes sense to me, actually, and I got to say that this year, as we've been doing more work on the segmentation, your opinion on this has been borne out in the numbers. When we look at the money-making small accounts, the money-making below average cash flow accounts, we are discovering that there is significant bottom line profit being generated in those accounts. And even though the relationships don't add up to an awful lot of volume in most cases, they do make a reasonably important contribution to the bottom line for the money-making accounts.
Yeah, and I would break the smaller accounts into two groups. There's the mid-market accounts, and then there's the very small accounts.
Yes.
And the mid-market accounts are great candidates for proactive inside sales. And when I say proactive inside sales, I mean hunters, not gatherers.
Yeah.
And we actually help a number of distributors get those programs going. The idea is that you've got an inside salesperson who can contact, I don't mean just call, contact 20 to 25, maybe as high as 30 people a week. So now your cost per contact is down around $8 or $9 or $10.
Right.
And that is aligned to the potential of the account.
Where we've always thought that a field sales call runs about $100. So,
Exactly.
yeah, so that makes a lot of sense. And the other thing that's sensible about this from a mathematical or analytical standpoint is that you're matching a smaller amount of cash flow dollars with a lower inherent or infrastructure costs by not having expensive field sales, not having, perhaps having the customers enter their own orders, using barcode scanning in place, doing things that basically make that part of the operation more efficient.
You also may not be giving away value-added services to customers of that size, which shows up in that cost to serve range, right?
Cash and carry, they're taken away. You're not giving away free delivery or other things that ramp up your infrastructure investment in each one of those accounts.
I think the other thing about these mid-market accounts is that when we estimate potential in an account, and we have an analytic method for doing that, we find that in aggregate, the mid-market and the small accounts have much more additional runway, much more wallet share that could be gained than the much larger accounts.
Is that due to the more professional purchasing that's going on, so the companies are fully availing themselves of the whole product line, or?
It could be that. I mean, that's definitely one possibility. Another possibility is it's just a smaller customer. It's a smaller business. They're not buying as much. And still another possibility is that there's somebody else's primary somebody else is their primary supplier instead of you.
That's been a common theme in our discussion, this whole differential between being the first source or second or third or fourth source. Is one of the contributors to whether the company is likely to fall into one of these high value categories. So does that apply here on the small accounts as well?
It does. Although when I think about it, I don't think that the mid-market and small accounts have a primary supplier as much as the larger accounts. They churn very quickly. I mean, if you look at the churn rates of your largest accounts, it might be 5 or 10% a year. If you look at the churn rate of these accounts, it might be 30 or 40% a year.
Yeah, they may just buy whoever they're closest to when they need something.
Right, but then if you start giving them some attention, you start giving them a little bit of love that's appropriate to the opportunity at hand.
Right.
That churn goes down a whole bunch, and those accounts can grow easily 10% a year for the first couple or 3 years.
Oh yeah, it's pretty easy for a $100,000 business to double its revenue and its consumption of things. It's pretty hard for $10 billion business to double its revenue and consumption of stuff. So that makes a lot of sense.
For both the regular profitable and regular unprofitable accounts, really one of the key drivers is are they in a good segment? And if they're in a good segment, then they're going to have more propensity to become a better account.
What kind of segment would you be talking about?
It would be a line of business combined with the size. So my classic example is Exxon buys batteries from you. The largest company buying the smallest possible thing from you. Well, that account may have more potential in it than a mom and pop shop on the corner.
Okay, for buying batteries as well. Okay,
right.
That makes sense. Okay.
So.
All right, so that's good. So there's a number of things. One of the things I would say about the small accounts is that the first thing you want to do is, in order to make them more profitable, you want to look at the infrastructure investment or consumption that you have in that group and think about the things that don't really need to be there. And you alluded to that in terms of talking about field sales, and that you're right. If accounts in these groups should not have salesmen assigned to them. They should be house accounts. They don't need the service. They don't want the service, and they can't pay for the service, and you can't price them enough to cover the service. So I think that's the first thing. The second thing is policies or business models need to be developed for them. And a business model being what you do or don't do. We don't do delivery for these guys, or delivery has a different policy and price structure than for the big guys. We don't have trade credit for these guys. It's all credit card or check, and so we don't have any receivables collection costs associated with this group. And so it's those kinds of things that apply to the regular accounts that make them efficient enough to get them there. And then there's one other thing that is really important, and that is if your entire organization and your core competency, the pick, pack, ship operation, is highly efficient, it's highly automated, if you have Amazon-like qualities there and have Amazon-like cost structures there, then you're more likely to be able to make money on regular accounts than a company that is using a traditional infrastructure with people pushing a cart around inventory racks in the warehouse. A lot harder for them to make those profitable. So you have to be operationally excellent to be able to make extraordinary profits in that segment. So I want to thank you for spending some time talking about segmentation with us. If you'd like to know more about segmentation, you can contact Real Results Marketing. They do very sophisticated segmentation work and help many of our clients identify the accounts that they need to go after in the marketplace in order to bring more of the right kinds of accounts into the business. And of course, you can use Waypoint to find out what the segmentation is in with your business, get some lightweight pricing information, and to know a great deal about what goes on in your business financially and operationally in terms of its profit value. So it was a great discussion. I'm really glad you were here this morning.
Thanks, Randy.
And we'll look forward to seeing you in future videos.